Hey everybody, in today's video, we're going to be discussing updated lead lifecycle model conversion rate benchmarks exclusive for B2B businesses for 2023. Hi, I'm Boulas, founder and CEO of Formulytic, a leading provider of both demand generation and revenue operations consulting services built exclusively for B2B SaaS organizations. Now, there's three core takeaways that I want to leave us with and address in this video. Number one, we're going to be discussing a traditional model. Understanding, however, that the model that we're going to be discussing is not meant to serve a one-size-fits-all set of use cases. There are obviously a lot of nuances and company-specific components to perhaps your business versus one in a different industry. Therefore, we have to approach these benchmarks that we're going to cover today with a certain level of context and understanding that your own interpretation may warrant some slight adaptation to fit within the confines of your business. Number two, we're going to be discussing the actual target conversion rates themselves for each individual lifecycle stage within the model. And number three, common misconceptions. For example, just because you have a high metric from one conversion rate stage to another does not necessarily mean that you're performing above average. We're going to come back to that with a practical example that we see most commonly for more mature businesses later in the video. So let's jump in. Like I said, we're going to be discussing today a traditional B2B SaaS specific lifecycle model that will enable the average organization to measure from anonymous prospect all the way through to closed-won revenue recognition across both a marketing and sales process. We are today not going to be discussing, let's say, an account-based engagement model, or conversely, a PQL or product-led growth-based framework model. There are certainly use cases where those different types of models fit in, perhaps for some organizations, even alongside or running concurrent to in a traditional inbound B2B SaaS model. We're going to save some of those more advanced topics for another video. But today, this is going to be really important for us to really come to consensus on together, predominantly because what you're going to find online is a lot of disparate information from a lot of disparate sources. Even as we look to historical industry thought leaders like the Serious Decisions Demand Waterfall, for example, we know that over the years, a model such as that one has even evolved over time to yield a more account-based approach. But that may not necessarily match where you are in terms of, business complexity or maturity internally within your own organization. And so we still see today very much the use case that a traditional B2B lifecycle model is being leveraged, which leads to a lot of ambiguity in terms of what good performing benchmarks should be adhered to. And so this is going to help us come to a point of alignment and serve as a basis for measurement, or at least at minimum, help find some areas within your business where you may be able to surface some increased efficiency. Okay, now getting into the traditional model itself, we're going to be starting off first and foremost with a lead stage, progressing into the MQL stage, moving therefore by way of marketing to sales alignment into a sales accepted lead stage, followed by sales qualified, moving now from an SDR function to an AE function into the opportunity pipeline, and then last but not least, the point of closed won. Now, before we actually go through the benchmarks themselves, the stages that I just drew attention to here audibly are going to be your more traditional stages that align against an inbound acquisition model. Okay, so what that means is that we are technically not accounting for, let's say, an outbound sales process that may run some interstitial stages or stages that might live tangential to the core set of stages that run top down under a purely inbound basis. For example, when you are, facilitating an outbound strategy in conjunction with an inbound strategy, what we see organizations most often adopting is, let's say, an outbound or a target stage that would live, parallel to or above your initial lead lifecycle stage. And the reality today is that on an outbound means of measurement, we do tend to see mixed definition use of stages in the mid-funnel, specifically those being sales accepted and sales qualified. We will generally run counter definitions for those two stages on an outbound basis versus an inbound basis. Today, we're only going to be discussing the inbound model, okay? Now, we can also potentially layer in a subscriber stage or a prospect stage that lives, again, above the lead stage, but this would be most applicable to businesses with lower level or lower barrier to entry calls to action, where it doesn't necessitate a full data profile on either a lead or a contact record for that prospect. The most common use case is actually a newsletter subscription where you might only capture, let's say, a name and an email address. And by the way, that email address may not even map to a business domain email. It very well could be a Gmail or an Outlook email domain extension, further limiting the completeness of the picture of who that prospect is very early on in your lifecycle model. So for our purposes, we're gonna start off at the lead to MQL stage first. Now, segmenting against your inbound calls to action, we're going to see a material difference between product-based calls to action versus those that would come in on lower barrier to entry content assets that may be gated, or purely on a scored lead basis. For your product based CTAs, you're essentially going to see an auto MQL rate that is either, all the way as high as 100%, or perhaps even as low as 90 to 95%, accounting for some drop off on those that would get auto DQ'd for any incomplete or inaccurate data that the prospect may have entered in. But generally, you're gonna see a pretty high rate of throughput there. More importantly though, when we're looking at the scored lead subset, for those that would not come through a more direct response auto MQL call to action, we're generally going to see MQL throughput at the rate of between 30 and 35% on average. For earlier stage companies with lower levels of monthly lead volume, we're actually going to see, even on the scored lead subset, MQL throughput rates of anywhere between 40 and 50% to allow sales more at-bats with prospects under the notion that there's not a lot of inbound volume coming in that would otherwise warrant a greater degree of prioritization. So for your average company that's either mid to late stage company, and when I say mid to late stage, we're generally talking about pretty mature Series B companies through those that have potentially raised even a Series C round. Suffice to say, these are organizations that do have some means of org structure delineation on the sales function, with an SDR or BDR team versus those that are account executives that would work opportunity pipeline explicitly. Now, as we move into the MQL to SAL stage, we do tend to also see rates that are pretty high. The reason for this, and this is a strong point of marketing and sales alignment, because we want, as marketers, to be facilitating and automated as much of the preliminary set of qualification criterion as we can. Because by the time we pass that over to an end SDR user to prompt follow-up activity, the reality is we want that SDR to raise their hand and say, yes, I am willing to work this lead. Also understanding the fact that SDRs are going to be comped outside of their base portion of their comp package on setting meetings, qualifying leads, and even a potential portion of their comp tied to opportunity pipeline dollars. We want to be mirroring or aligning with them on what their incentivization structure looks like. And so for as much as we can ensure that those prospects that sales is raising their hand in saying, yes, I want to book a meeting with this person, that behooves us all, right? Because now we're running an efficient model that is one in which we have a high degree of perceived value in speaking with that prospect even before they've gotten on the phone with us to talk through and validate qualification live on a call. Now, switching to the next phase of the lifecycle model, as we get into the progression from SAL into sales qualified, for your average organization, this is going to largely comprise of BANT-side qualification, right? So this is going to typically yield a conversion rate of somewhere around 40% on average, okay? And this is really important because we want sales, or the SDR user in particular, to walk away from that call feeling as though they have the right prospect from the right company with a validated need and use case of which whatever your SaaS application solution is solving for will meet that prospect's needs. And so you're generally going to see, just shy of half, let's call it, from your MQL through to your SAL/SQL stages. We're going to come back to at the end of this video and kind of recap some overall throughput metrics. But for now, we really want to be targeting a rate of sales qualification from those that sales is willing to try and book a meeting with at about a 40% rate. Now, here's where things start to get interesting, because you can have a number of follow-up conversations with that prospect between the point of sales qualified prior to them entering the pipeline. For example, you might walk away with a specific set of follow-ups that the prospect wants some specific information or more definitive answers around to kind of further validate the use case. And whether that's one additional meeting or whether that's 2 or 3 more additional meetings, the idea is that we want to be targeting entrance into the pipeline from that subset of sales qualified leads at about a rate of 70% throughput. And perhaps the largest driver that will push that metric up is through the adoption of product-based calls to action that, had they not been used as a means of top-of-funnel acquisition, serve as a greater influence on sales enablement in the mid-funnel. In layman's terms, pulling in your demo experience as part of one of those follow-up calls. That becomes a really tangible and eye-opening exercise that directly shows how the product solution set can solve their challenges within an operating environment on an average day-to-day basis. And so ultimately what that yields is a much greater degree of overall throughput, even down to revenue, when you use your product as a selling tool and jointly as a broader sales enablement tool. Again, we're going to talk more in different content pieces down the road about how we can affect product adoption through a PQL-based model. But for now, you're going to see higher rates of throughput when those types of calls to action are introduced as selling tools. Now, by the time we get to the opportunity pipeline, we're generally aiming to close at a 20% rate on new business opportunities. Effectively, between opportunity created / op stage 1 all the way through to the point of closed won, if we're closing 1 out of every 5 customers or prospects rather, that is a great health metric and shows that the AEs responsible for yielding revenue from a pipeline dollar amount are performing to a very healthy degree. There's obviously many ways that you can segment those metrics, certainly at an individual rep level to kind of figure out if there are certain AEs that are performing above or below threshold, or even if everyone on the AE team is performing below, then that can point back to a value prop misalignment or a host of other things that we can dig into at a later time. Now, as I mentioned a couple minutes ago, what we want to do is we want to be able to come up with broader benchmarks that can overall show efficacy as it relates to the entirety of the model as a whole. So really the highest level metric that you can look at from top all the way to bottom is your average lead to close rate. Now you need to run this data with at least some semblance of what your average tenure or duration of the lifecycle model is. Obviously, that's going to be much greater for a higher ACV enterprise ICP audience as opposed to one that is appeasing, let's say, the SMB or mid-market. There can obviously be a lot of variability there, but on average, if you can close 1.5% to 2% of all inbound leads that are coming in, then you're performing at a great, average benchmark. Once you start to bring in those product-based calls to action into the fold, you can effectively see upwards of a 5% closed win rate off of, again, your top line lead number. But generally, in absence of a product-based call to action, and when you're really relying on a lot of content-heavy materials to facilitate the buyer journey, you're going to generally see a lead to close win rate of closer to that 1.5% to 2% mark. Now, as we start to pick apart different pieces of the funnel within the overall breadth that we covered there, you're generally going to also want to aim towards about an 8.5% rate of lead into the opportunity pipeline. I would say safely anything between about 8.5% to 10% is going to be a great barometer of success for your marketing and sales efficiency, certainly in the top to mid funnel portion of the process. So suffice to say, if you're able to generate 8 to 10 new business opportunities out of every 100 inbound leads that you're generating, that gives you at least some semblance of a ratio that you should feel confident about if you're already performing at that type of level today. Now, let's last but not least cover some of the common misconceptions that we see in some of the actual data that we collect on behalf of clients, both historically and currently today. The most common use case we see is a marketing and a sales function that grows in maturity beyond what the current lifecycle model that is being used is able to support. Meaning, we are effectively building out a lot of breadth and sophistication in the marketing and the sales process that actually doesn't get measured to the degree that it should by evolving and optimizing your lifecycle model to report on said expansion activity as you grow. Let me paint you a picture of a very clear example. It is most common for us to see a scenario where opportunities are being added to the pipeline without adequate pre-qualification first, only to then turn to closed loss later once those pipeline dollars have already been forecasted. Effectively, what that means is a lifecycle model that generally sees a lot of speed and velocity in the top half, which then it's almost like ripping the Band-Aid off, inversely slows all the way down once it hits the pipeline. And I can't tell you all how often we actually see this as a common mistake. The reality is, when you're looking at your opportunity close rate, if you're only seeing a close rate on average of 5-7%, and I'll tell you, I've seen it. I hate to say it, but I've seen it. If you're only closing as low as that when we just agreed that the benchmark that you should be aiming for a healthy SaaS business is 1 out of every 5, aka that 20%, that should give you pause for concern, right? If you're seeing that, and this is gonna be an exaggeration, of course, to highlight the point, but if 1 out of every 3 or 1 out of every 4 inbound leads is hitting the pipeline, yeah, on average, that looks like you're killing it, right? You have a 75% throughput into the pipeline. But oh yeah, by the way, you're only closing at like 5%. I know it sounds silly, but I can't tell you guys how often we see it. And it's the result of fast growth. The reality is that when we see that, it is highly correctable, but it causes a lot of pain and frustration for internal teams before it is identified and addressed. The reality is that certainly when you have a more mature organization with a CFO who's very in tune with revenue recognition, or perhaps even a chief revenue officer who relies on HubSpot or Salesforce side forecasting, right, to drive not only revenue projections, but even, new quarterly, goals, right, that the team is going to be driving to. The reality is that you're going to be inflating your pipeline dollars that aren't actually real. So what we want to be doing in our marketing and our sales functions is really architecting automated and efficient flows through really strong intra-team alignment, so that we are able to really rely more accurately on our forecasting reports in the pipeline with healthy output numbers that are scalable and repeatable. Okay, as always, to recap, I know that what we covered here are some really high-level barometers that I think are great milestones to track in 2023, but it doesn't end there. I fully recognize that not every organization even has an outbound strategy, or may, in some cases, only rely on outbound, and we do see that too. But again, a lot of the data is nuanced. There is no one-size-fits-all model. What you can do, if we covered a particular stage here that you may not map to internally, what's a really helpful exercise is to map out the stages you do have and fill in some sample numbers in one column on a spreadsheet, and then take some of the benchmarks that I just gave with these stages and put those side by side. And then what you can do is you can do the math and back into what your rates should be had you adopted some of the stages that perhaps you don't have, to give you a more clear indicator of how your own performance compares. Thank you all for your time. I am going to be monitoring comments on this video. I encourage you to leave your feedback. I would like to engage with everybody. If you have a follow-up, maybe something you want to hear from me in the future, if you disagree with anything that I said, or you even see perhaps some altering data internally, would love to discuss. You're also welcome to drop me a line directly at chris@formulytic.com. And thank you all once again, and I look forward to producing more content. Thank you.